wealthbranch.com.
Relative valuations and multiples. Prerequisite. Because Professor Damodaran's course on relative valuation is so great, it's a prerequisite to this lesson. This lesson will mostly consist of breaking down some of the complexity and reviewing his teachings. Unless you're an above-average learner or have a lot of investment experience, some of this material is dense and may take several readings and watches to absorb it all. Relative valuation. Professor Damodaran, in his much-watched lecture, explains,
Before I delve into relative valuation, I should also tell you that relative valuation is pervasive. It's all around us. In fact, to show you how pervasive it is, I'll give you a couple of statistics. About a decade ago, I collected about 550 equity research reports from around the globe, different investment banks, different equity research houses. I must confess, I didn't read most of them. I collected them because I wanted to categorize how equity research analysts approach valuation. Out of the 550 equity research reports, about 45 were discounted cash flow valuations, less than 10%. About 450 were relative valuations, a multiple and comparables. The remaining 55 were kind of fuzzy. I couldn't quite categorize them. But among the ones I could categorize, 10 to 1, relative valuations outnumbered discounted cash flow valuations. I took a look at about 100 acquisition valuations, hoping or expecting things to be different in corporate finance. Out of the 100 acquisition valuations, I got a much more even split. About half were discounted cash flow valuations, half were relative valuations. But then I took a closer look at the half that were discounted cash flow valuations, and I noticed that in most of them, the biggest number, the terminal value, was estimated using a multiple. So even those were really relative valuations. Almost every rule of thumb you see out there is based on a multiple, right? What am I talking about? Price to book less than 1 is cheap. A price earnings less than 10 is cheap. They're all based on multiples. What I'm trying to say is the language of valuation around us is the language of relative valuation.
Why is relative valuation pervasive? Professor Damodaran explains why relative valuation is pervasive.
We forget how much of valuation is selling, right? So if you're trying to sell me something, it's far easier to sell me something with a relative valuation than an intrinsic valuation, because here's all you need to do. You need to find something even more overvalued than what you're selling me. You say, look, it's cheap. It's cheap relative to these 5 other things I found out there. Relative valuations are far easier to sell than intrinsic valuations, because as long as you let me pick the multiple and you let me pick the comparables, I can tell you whatever story I want to tell you. Second, it's far easier to defend a relative valuation than an intrinsic valuation. And here's why. In intrinsic valuation, your assumptions are all explicit. Everybody can see what you're assuming about cash flows and growth and risk, and that's dangerous because they can pick it apart. In relative valuation, all your assumptions are implicit. So when you use 12 times EBITDA, you are making assumptions, but nobody can see what those assumptions are. And if they cannot see them, how can they pick them apart? And third, and this is something that we don't factor in enough when we think about valuation. I personally think in the long term, you're far more likely to be right with intrinsic valuation than relative valuation. But here's the catch. When you're wrong with intrinsic valuation, you're also far more likely to be wrong alone. You're saying, so what? If you're wrong alone, you tend to be fired. If you use relative valuation and you're wrong, you're always going to have lots of company. And that's a safe place to be. The survival instinct kicks in. And that's why I think more people use multiples than intrinsic valuation. Even if you're a true believer in intrinsic valuation, here's my advice to you. Understand relative valuation. Keep it in your arsenal. It doesn't have to be an either or. I am a true believer in intrinsic valuation, but I still do relative valuation. I'll often frame my intrinsic valuation in terms of relative value. So don't give up on relative valuation.
Multiples. In general, people tend to use relative valuation to value companies. Multiples are the most commonly used method. In Professor Damodaran's much-watched class, he has a great way of thinking about multiples.
To make comparisons across companies, you got to use a multiple. And every multiple is a numerator and a denominator. And here's the way to think about it. In your numerator, you almost always need a measure of market value. That market value can be just of your equity, that's market cap, as is the case with price earnings ratios. It can be market value of equity plus the value of debt, which is the market value of the firm. It can be market value of equity plus debt minus cash. That's called enterprise value. So in almost every multiple, you're going to see one of those three numbers: market cap, value of the firm, or enterprise value. The difference between enterprise value and firm value is enterprise value is net of cash. So it's firm value minus cash. In the denominator, you can see one of four measures. You can see revenues, because you're wary about accountants and what they can do to the bottom line numbers. You might see earnings per share, operating income. You might see even measures of cash earnings, EBITDA. You might see book value of equity, or book value of the entire firm, or you might see some sector-specific measure. What am I talking about? Remember the late 1990s when .com companies were compared based on value per website visitor? You can compare steel companies by dividing the market value by the number of tons of steel they produce. But basically, it could be some measure of operations: market value per employee, market value per unit output. But in all of these measures, what you're trying to do is you're trying to scale market value to some common variable. That's the first step in relative valuation, is to get a sense of what those multiples are.
Now that we understand relative valuation and multiples, let's review why multiples can't tell you the whole story about valuing an asset. Imagine you're an out-of-state real estate investor and you're looking at two houses. Both houses have the same square footage, selling for $200 per square foot. You look at the price per square foot and say both houses are equal value. Now, let's say House B goes on sale for $150 per square foot and you decide to buy it because it looks cheap. Shortly after, you decide you want to buy a different property and want to sell House B. After an appraisal, the appraiser tells you the price per square foot is now $100 per square foot. You call your real estate agent and you say you're flying in and want to see both houses, A and House B, to know why the prices are so different. House A is beautiful. It has granite counters, a perfect layout, perfect paint, solid construction, and you can tell the owner spent years taking care of this house, not to mention the lot is the most desired in the neighborhood. You visit House B and there's something off about this house, but you can't quite put your finger on it. The counters are granite, but a weird color. The layout isn't quite right, the paint lines are a little crooked, and it seems poorly constructed. You can tell the previous owner didn't care about this house. Also, you decide to get an inspection and find out the home is in way worse condition than you initially thought. You find out the foundation, air conditioner, roof, and water heater need to be replaced. Ultimately, the price per square foot couldn't tell you the whole story. Like stocks, the multiples cannot show you everything.